In this final video on capital budgeting risk, let's continue our discussion of how we might adjust our analysis based on risk, right? So again, if we assume a plus or minus 4% risk adjustment for cost of capital, how would that play into the decision, right? So again, as I mentioned, if we have a very high risk project, maybe we add a couple of percent. A very low risk project, maybe we subtract some. If there is a project that we can identify that has a very specific discount rate attached to it, maybe we use that discount rate rather than adjusting our discount rate. One example of this might be, and companies don't do this, but what if a company wanted to invest in treasury bonds? Well, we know treasury bonds have a yield to maturity currently, 30-year bonds of around 3%. So that is the discount rate that we should use when analyzing an investment in a project, in quotes, of treasury bonds. So if we can find something specifically like that, then maybe we should use that discount rate. And I will tell you that there is a lot more to this story than what this course, what these videos are covering. In later videos, we will discuss some of the more substantial adjustments that we can make to risks and returns. Should we include any type of subjective analysis? I mean, this is always a question, right? I mean, you know, we can quantify many things, but there is a point in time where maybe you need to adjust things just because of a gut feel, right? So sometimes it just isn't, you get the number and for some reason you have a feeling, right? Not a feeling just because it's an intuition, but maybe as this thing talks about, you know, maybe there's a potential for a lawsuit. Now, how do you quantify that? I am not sure, but maybe if there's a potential, maybe we want to upward adjust the weighted average cost of capital. What is a concept called a real option analysis? This is where I kind of talk about these things as kind of like being curveballs, right? These are just additional techniques, refinements, if you will, to how we make analysis of particular parts of projects. So real options are valuable, but by their nature, they're not really included in conventional analysis. So what can these events, what can they be? Well, there are several things. We can talk about abandonment, right? When would be a good time to leave this project? Or maybe added another way, what if the project turns out to be a total bust? What happens if we have to leave this at the end of 1 year, say? What would that impact be on the net present value of the project? We can look at some timing issues. Expansion, right? So we're going to expand into another country. Maybe we start small. And the option is, if it seems to work well, maybe we expand into a bigger project. Well, that bigger project is the option. Do we do it or don't we do it? And we can incorporate that into our analysis. So let's take this project. So, and this was, you know, should we stop this project? So here we have a project, has a net present value, it's a negative $1,000, right? So it's going to produce $80,000 a year. Weighted average cost of capital is 10%, right? So what happens if we want to abandon this, right? So the cash flows obviously are dependent on customer acceptance. There's a 60% chance that it will be wildly successful, and there's a 40% chance it's going to be bust, and there'll be annual cash flows will be negative 25,000. So that's the option. So in this case, says what we have here is the 60% chance of this part of the decision tree, right? You spend 200,000, you get 150,000 a year, but there's a 40% chance we spend 200,000 and we lose 25,000 a year. Calculate the net present values. If it's good, it's 173,000. If it's bad, it's negative 262. So we can plug this into a formula, a weighted formula, right? 60% chance of 173, 40% chance of negative 262. That gives us an overall net present value expectation of a negative 1051. So we might say in this example, we don't want to do this project because of the potential of a total bust. What about just abandonment, right? What if after 1 year we decide, we can't do this project. We just need to abandon it. How can we do this? Well, we need to predict cash flows if we abandon. So in this example, there's a 60% chance it's really good. There's a 40% chance we spend 200,000, but we have to get out at the end of the first year. It costs us negative 25,000. So again, you calculate the net present values, and if we do this for just 1 year and get out, the net present value is 14,725. So we would still go ahead with this project. Now what we might want to do is say, okay, well, what happens if it goes 2 years? So now it'd be negative 200,000. Then this second year, we'd get that 150 if it happened. And then here, again, let's just say we have the negative 25. So then we would have an expected net present value if we did it for 2 years and then 3 years. What we would like to do is we would like to repeat this project until we receive the maximum amount of net present value available. So again, that is a step further in the complication of what do companies do when they're deciding to do projects or not. Again, a final question. If we're going to incorporate these other things, right? These other potentials, this real option types of events, if we're going to include them, should we adjust the weighted average cost of capital? Well, if we're taking them into account, then there's the chance that we could be reducing risk in the case of abandonment, right? If we can get out quick without wasting a ton of money, should we get out real quick? So that's the type of analysis that we can ultimately do. And I just want to kind of end this discussion on capital budgeting. That is a very, very complex question in a company. The company has a strategic plan, and the vision within that strategic plan is that the company is going to buy assets. The assets that we buy, the decisions we make, will ultimately determine the success of the company moving forward. So this is a very critical question for companies when they're thinking about buying assets. Hope you enjoyed the video. Talk to you soon.